I bought a 1 bedroom plus den and a 1.5 bath. So this is the condo, the rendering of the condo building that we have bought, because the Go Line extension is being announced and that station will be right next to this particular development. But the problem is that when they launch their projects, they are, in my view, overpriced. I feel that we are gambling more than investing. But there is also a risk that, the tenants might not pay. So plus, it's not the best time to have tenants anyways. Home only has about 60% loan left on it. I might upgrade into a bigger house. Why Precon for me? I could have bought a resale house as well. We made our 5th real estate investment and first for this year, and I am going to talk all about that in today's video. So let's get started. So if you have been following me on Instagram, you know that we have invested in a pre-construction condo in Milton, and we are going to talk about 3 things today. Number 1 is what did I buy and for how much. Number 2 is how to analyze a Precon deal, because what I bought is a Precon delivering in 2027-2028. And finally, we'll touch upon why I bought Precon and what are the personal reasons why I did not go for resale in today's market. So let's talk about what did I buy. So this is the condo, the rendering of the condo building that we have bought in Milton. A little bit of details around the project. The project name is called Station Side. This is by Neat Communities, that's the builder, and the location is downtown Milton, right on Main Street, in the middle of all the hustle and all the development in Milton. We'll talk about location in a bit. Then in terms of the unit itself, I bought a 1 bedroom plus den and a 1.5 bath. This is an overall square footage is about 634 square feet, which is 605 square feet inside and 129 square feet is the balcony. It includes parking and locker. There's free assignment. There's just a small legal fee with the assignment that I need to pay, but overall it's a free assignment. But that's not the reason why you should buy a Precon, and I'll touch upon that also in a bit when we do the numbers. Then there are five free appliances that will be given to me with the unit when the possession comes, and then they also gave us a shower upgrade. So this is what I got, and the price for this is $646,000 inclusive of HST, and the occupancy is mid of 2027. And with these long projects, there are always delays, so I'm assuming that by end of 2027 is the best possible timeline. But even if it's mid of 2027, it's pretty good. So it's about 3 to 4 years down the line, so I have enough time to prepare. Now, I have made many videos in the past where I said that Precon is not a very good investment. And the reason why I say that is when you invest in Precon, which is delivering in the next 1 to 2 years, I feel that we are gambling more than investing. And the reason why I say that is because the political environment right now is not that conducive. We all know what the economy is going through. The affordability is really not there right now. Jobs are not there right now. I have made several videos on this, and in this environment, I'm not comfortable closing something 1 to 2 years down the line. And that's the reason why I am much more bullish on 2027 and 2028. And the reason why I am more bullish on 2027 and 2028, and that's the reason why I invested in a Precon project that is delivering in that timeline, is because we'll be out of a recession and we'll be in the starting or the middle of a boom market. Now, we all know that economies run in cycles, and this is a down cycle that we are going through, and I'm assuming that in the next 2 to 3 years we will be back to an up cycle, and that's where I'll ride this wave of that up cycle, and I'll be in the starting or the middle when I invest in this particular Precon. And obviously the numbers need to make sense, and we'll talk about that in a bit as well. The second reason why I am bullish on 2027 2028 is because there are 2 million people who entered Canada. The population increased by 2 million in the last 2 years. In the last 9 months alone, we have 1 million more people in Canada. The population is at 41 million. Yes, there is reverse immigration happening, but the magnitude of that versus the number of people who are coming in, despite the cap on the number of students who are definitely not competing for this particular market right now, I think it's still, immigration is at its peak right now. And these 2 million people, if I assume 2 to 3 people in the household, they'll buy at least 700,000 homes in the next 3 to 4 years. And we don't have these additional homes because we are already short of 2 million homes in Canada as of today. And this shortfall is bound to double with all the immigration that's happening and all the supply shortage and all the levies and the red tape that is involved in building new homes. We are set to double this shortfall by 2030, and that's the reason why in a high market, when everything is going crazy, people who are renting right now at very high rents, they'll all buy. I really feel that 2027 and 2028 will be the years where we can make a big bang in real estate. Now that you know what I bought and why I chose the closing as 2027 2028, I chose a project with a closing, with a long closing. Let's analyze a pre-construction, and I'm analyzing this project as a specimen for whatever pre-construction project you are analyzing. You will actually use the exact same method to do it, and I'll actually run 4 parameters here. The first one is builder reputation. That's probably the most important thing. The second one is location potential. I'll be then talking about the price analysis, how to do cash flow analysis, how to do ROI analysis. So we'll do all that. And then finally, we'll be talking about the personal situations, and I'll talk about my personal situation of why I bought this, why it made sense for me. And then you can connect it back to yourself or book a call from the description to make sure that you know what you're doing and whether this is the right move for you or not, because I genuinely believe that not everyone should buy this pre-construction that I bought, but there are certain situations where it could be a good idea as well. So if you are confused, then book a call from the description. In the price analysis, it's not just a price analysis on this condo, but I'll also compare the amount of money that I'm putting in deposits. And if I were to, instead of buying this pre-construction, if I were to put it in stock market, what would be the difference in the kind of returns that I can expect in the next 7 to 10 years? We'll talk all about that in the subsequent slides. First, let's talk about builder reputation. The thing is that Neat Communities is a new builder. Now you might say that, Navjot, what are you doing? Are you crazy? Why are you investing in a new builder? So what I did was I wanted to research a little bit about this builder, what it's about. And I actually went to their website and I saw, how many projects they have done. So they have about, $3 billion in development right now, which is pretty good. They have about 7,000 plus residential units which are coming, and they have about 30 plus years of experience. Now that's not enough, right? So the reason why I'm saying this is because 30 plus years of experience doesn't mean that Neat Communities is 30 plus years old. It just means that the principals and the people who are making this, the people have 30 plus years of experience. So I was like, yeah, it's decent, it's a little bit misleading, but let's just, go on to the team as well. So then I saw the team that is behind this project. Now, if you look at this person, this is the person who is basically the CEO, essentially Mike Vanui. And this guy, if you look at his LinkedIn profile, I actually went there and yeah, it'll load in a minute. So this guy is ex-Matamy. So you'll see that he was the senior vice president land development of Matamy. So this guy is the reason why Matamy owns. If you know Milton, you would know that a lot of Milton is owned by Matamy. A lot of land development is done by Matamy, and this guy was responsible for a lot of that development. He's the brains and the mind behind Neat Communities, and that's the reason why it gives me a lot of confidence that they are the right people. If you go to LinkedIn profiles of a lot of these people, they are all ex-Matamy. So this guy actually brought a lot of his team, and I'm assuming it's a really good team that he brought on, and they are the reason why I have a lot of confidence in this particular community. Going back to the presentation, yes, it's a new builder, but it's a very experienced team, and they are ex-Matamy, and they are the brains and mind behind how Matamy was able to do so well in Milton, and that's the reason why I invested in this particular project. So even if the builder doesn't have a lot of experience, but the people behind them are really strong. Now, there are certain builders who have a strong reputation, just like Tridal, but the problem is that when they launch their projects, they are, in my view, overpriced, and that's the price that you pay for a good builder, and that's okay too. Now, I'm not saying that everyone should go with new builders. Now, this is a strong team, and that's why I believe in them. However, we also need to consider that all good builders would actually price their projects accordingly. They would be more expensive because of their reputation. And that's where I like this builder, where it's a strong team, it's a new builder, and therefore the prices are not that crazy. Now, let's talk about the location. Now, honestly, I would have loved to invest in Toronto, downtown Etobicoke, South Etobicoke, near the lakeshore. But the thing is that all these communities are already built and there is less potential. So yes, there is current potential, but they are also priced accordingly, and therefore I was not getting the right price point, and hence I looked at Milton. Now, if you talk about current potential, it is GTA. So, it's very close to downtown. It's not very close, but it's, closer to downtown than, where I am in Kitchener. And it's Canada's fastest growing city. If you talk about 100K plus population, this is as per StatCan. Now, obviously, we can't believe all the sources, but StatCan is one of the, okay resources to follow. Now, if you look at these top, municipalities which are growing in terms of population at the highest rate, you would see that, and this is again is pan-Canada, you would see that a lot of these communities have very low population. And this is obviously as per 2021. From 2021 to now, there is more expansion across cities. But this, of course, the census happened in 2021 and that's where the numbers are. But if you look at these, fastest growing communities, there are very few of these communities that you already know of. And therefore, if you go down, you would see that a lot of these communities have very less population. But there's one community which has over 100,000 of population, and that's basically basically Milton. So it becomes the fastest growing community in terms of population with a 21% growth, 20.7% growth, and it's the only community which is over 100,000 people, and it's bound to increase to almost 300,000 people by 2030. That's as per the City of Milton website, and with the kind of people or the amount of people that are moving and the development which is happening, I will not be surprised if we double the population by 2030. The other thing is that this particular community is 4-minute drive from Milton Go, and it is the 4th busiest station on the Go line right now. With the increasing population, the frequency is a little bit lower, which is bound to increase in the next 2 to 3 years, but it is one of the busiest lines on the Go line. But that's not all. The reason why I wanted to invest in this project is because the Go line extension is being announced and it will be built by 2031, and that station will be right next to this particular development, and that's why the name station side comes from. It's right next to the station. There is also a pedestrian bridge that will be built with the existing Go station. So even if this proposed, extension doesn't happen, there will be a bridge that is created, and that would actually reduce the amount of walkable distance. Walkable distance right now is about 20 minutes, but it will reduce to about 10 minutes when there is a bridge there. And I'll talk about that in the next slide. It will be more visual there. And there is a massive Milton education village that is being created, and Wilfrid Laurier and Conestoga campuses are already there. They are just 6 minutes from station side. It will employ about 2,500 people, this village, and there will be so much startup ecosystem that will be built in Milton, and all that is coming. It's already there. These 2 campuses are already there, but a lot of the development is happening in this MEV. It's called the MEV project, Milton Education Village, and I'm really excited. And that's another reason why I wanted to invest. Now, if you look at this development, I'll just explain this chart to you. So this is the development. This is where I bought. This is the building that got launched. This is a future development, and these townhouses will also be a future development. Now, right now, the Milton Go station is this way. So if you look at this chart, this is the building. Here's a track, and the station is on the other side. Now, one of the things that is happening for sure is that there will be a bridge connecting this side and this side. Therefore, you can actually walk up, on this line, and then you can cross over, and then you can go to the existing Go station. That will reduce the walkable distance by a lot. The extension which is coming is actually here. So this extension will not require you to, cross the bridge, and therefore it is very, very close. You would see that, from the building, it's actually connected almost to the building, and that would mean that the walkable distance will be less than a minute to the station, and that increases the value of this particular development a lot. There is future development also coming with the same builder. So there are, I think, 6 buildings that they are creating, and one of them, the next one, will be here. After this phase is complete, this is the next one, and there are other buildings that are coming up with the same builder as well. And that's the reason why I really feel that there are very few places now which are available right next to the Go station. And if you remember my Calgary investment, it was also led by a similar news that came, where the C train, which is the Calgary train, like we have the Go train in Ontario, that was getting extended to Seaton. And I got that news, it was there, but it was not announced in the media. And that's where I invested into Calgary, and that paid a lot of dividends. The house prices are up there by a lot. I bought it for $500,000. It's now at $650,000. And therefore, I really feel that these kind of announcements, because Go extensions are not that common, and there is less land available around the Go stations, I think this will be a one-off project which can be a huge success, and that's the reason why I invested in it. Now that we understand the location, let's move on to the price analysis, and let's reiterate. The purchase price is $646,000 inclusive of HST, 1 bedroom, 1 den, 1.5 bath. It's very rare to get a 1.5 bath, with a 1+ den. So it's a pretty good, it's a pretty good unit. And the plans I really loved, because it's a 734 square feet unit. And right now, a lot of the units that are coming up are very small. This is not the case with this particular one. It includes parking and locker, free assignment, 5 free appliances. There's a shower upgrade as well, and occupancy is mid to end of 2027. Now, when looking at price, there are 3 things that we need to look at. The number 1 thing is recent comparables. We need to look at, if you were to buy, instead of buying this pre-construction, if you were to buy it resale, a similar unit, what would it cost right now? We are buying for 646. We are getting the possession in 2027, so we are locking the price for 2027. But what is the differential? Obviously, it will be lower, but how much lower is it if you were to buy, instead of buying this pre-construction, a resale unit which is similar? We'll also look at the peak comparable for 2022 2022, I think this is a blessing in disguise, because 2022 was an unprecedented market. The market just increased by 30, 40, 50%, 60% in some cases, in some markets. And we can actually look at the comparable in 2022 to understand what would happen 3 to 4 years down the line. Because even though 2022 prices were unprecedented and, but it did show us the future, because we will reach those prices because people were willing to pay that price at that time. So we look at the peak comparables to just understand where we can be in 2027. And then finally, we look at cash flow and returns. So the rest of the presentation I'll be talking a lot about this. Now let's look at the recent comparables, which is number 1. So what I've done is I'm actually at House Sigma and we are at map view. For those of you who don't know House Sigma, it's an amazing app where you can actually do the comparable analysis. You can see how much, like houses are being listed for, and not only that, you can actually see how much are they being sold for. So what I've done here is that I've done for sale. You can just download House Sigma. It's a free app. You can do it on your phone is better, but I'm just showing it on the laptop. I just chose condo apartments because that's the comparable that we are looking at. I'm not looking at any max prices. I'm not looking at active listings or anything like that. I'm looking at the sold comparables in the last 90 days. It will give me a list of all the houses that are being sold, like condo apartments that are being sold in the last 90 days and what the price has been. Now this is the Milton Go station right now. Now the buildings that are available here, the problem is that they are all old buildings. You'll see that a 1+1 one bedroom has sold for $575,000. But the problem is that this is a very old building. This is almost 10 years, 11 years old, and it's not as fancy. And the parking is usually surface level parking, which means it's not underground parking, and they are low rise. A lot of these condos are low rise. But I was able to find slightly newer building, which is very close comparable to the one that I have bought. So if you look at these, these actually sold. So, let's talk about this one. So 24th January 2024, 1+1, two bath. It's a new building. It's like less than 5 years old and it sold for 560. If you talk about, like in February, a recent one, similar one sold for 588. And then there's another one which sold for 585. So we know that the comparable is around $580,000 to $585,000 for this particular unit right now if we were to buy it resale. So after we know that $580,000 is probably what the current units are being sold at, what I've done is this is a table and I'll explain it one by one. There'll be a lot of numbers, like always in all my presentations. So bear with me. I'll try to explain this. This is the current price if you were to buy it as a resale, $580,000. Now I've taken 3 scenarios here. I've taken a 3% increase every single year till possession of station site. I've taken a 4% increase and a 5% increase. So 3 scenarios here. If we take a 3% year-on-year increase, the $580,000 unit, which is available right now, it will be worth about $652,000 or $653,000 by 2027. And if I go all the way to 5% year-on-year increase, which is, I think, more realistic, and I'll talk about that in my second point in the pricing analysis as well, where we look at peak comparables, this particular unit will be worth about $705,000. So when we are looking at these numbers and we are doing these projections, we need to ensure that these numbers, all of these numbers, including the 3% one, obviously the 5% one will be higher, has to be more than the price that we buy the pre-construction at. And this is true not just for station side, but any price comparison or price analysis that you're doing for any pre-construction project. If this number is less than, like the purchase price is more than, what the 3%, year-on-year increase numbers look like, I would not recommend buying it. But in this case, the 3% year-on-year number is actually higher. So that means that even if the market increases by only 3% every single year, we would still break even. Just so we understand why I took a 3 to 5% year-on-year increase, on average in the last 20 years, a Canadian real estate has increased by 5% year-on-year. And if you look at, since 2017 to today, it's almost 7 to 8%. So if I take 3 to 5%, I'm not taking crazy numbers. We are at almost the bottom of the market when it comes to condos, and it's only going to go up with the increasing population and the supply demand gap that we have right now. So the second thing that we need to look at is the peak comparables back in 2022. Now, if you look at the same buildings that we took the 580, 585, the one that we saw on House Sigma, I actually looked at similar comparables in the same building that got sold in the peak of the market, which is Feb of 2022. And we see that similar comparables, 1+1, 2 baths sold for about $700,000. There's another one in February of 2022 that sold for over $700,000. And then there's another one which sold for about $690,000. And this gives me a lot of confidence that if I take the 5% year-on-year increase and the numbers that we took in the previous slide, 704,994, these are actually very realistic estimates for where we will be by the time we get possession for this particular unit. So we looked at the current comparables and then we extrapolated 3 to 5% and we understood that the price that we are buying it today is actually very much comparable and we'll at least break even at 3% and we will probably be a lot ahead because the comparables in 2022 were a lot higher. It's closer to $700,000. So we are making a good choice when it comes to the price. But we also need to look at cash flow. So in terms of cash flow, let's say we close this at 20% down payment because it's an investment property. There's closing cost involved as well. That's about $20,000. I will take a loan of about $517,000. Assuming a 4% interest in 2027, 2028, it could be a lower than 4% as well. But let's assume 4% interest, 30-year amortization, which is basically the length of the loan. My mortgage payments will be about $2,450. Condo fee is about $430. We already know the condo fee, so that's about $430. Property tax will be about $200 to $250. It will be closer to $200 because there is a lot of industry there, and therefore the in Milton the property tax prices are a lot lower. But let's assume $250. And insurance another $100 because we need to buy insurance when we are a homeowner. So overall expenses will be about $30 to $30 at these numbers. And the estimated rent right now it's about $2,350 for a similar unit. I've taken a 3 to 5% increase every single year, which is I think very realistic. In fact, there is likely to be a rental crisis at that time because there will be a lot more renters because the property prices are increasing at exponential rate. But let's assume that the estimated rent at that time is $2,700, which has increased about $250 in 3 years, 4 years time, which is not crazy to believe. And then the cash flow will be negative $500. Now I want to be very clear on one thing. If you're buying a condo in GTA, if you're doing a 20% down, you cannot cash flow unless the rates go back to 1%, 2%, which I don't see them going back to. You cannot cash flow on a condo. So the only reason why you are buying a condo, whether pre-construction or resale, is because of its future potential. It's because of appreciation, which is not always the right decision. However, I will give you my reasons for why I bought this, even though I know that I might be cash flow negative. So that's the cash flow analysis. Now, I have something crazier here where I did the price analysis and where I will be in terms of appreciation, because that's why we are buying this, for appreciation in the next, by 2027, or in fact, in my case, I want to keep it till about 2032 because Ghost Train extension is likely to be built and completed by 2031 as per the reports, and I want to sell it after the Go extension is actually in force, and I will get the maximum bang for buck if I wait until 2032. I've taken 2027 as the possession and I've taken 2032 as my sale timeline. I'll sell this condo in that timeline. So what I've done is you would invest obviously now if you're buying today, we have to do a 5% down payment. So there is a payment structure here. So for $146,000, you don't have to pay the entire 20% right now. You can actually stagger the payments 5% every single year. So that's what I've taken. I invest $32,300 in 2024. I then invest another 5%, $64,600, so $32,300 plus another $32,300. So overall invested money will be about $64,600. Then by 2026, I put in another 5%. So my overall invested money is $96,900. And then 2027, including the closing cost, because I'm closing in 2027, I would be putting 20% down payment plus the closing cost. So my overall invested money would increase to about $149,200. And my overall, invested money will remain the same until 2032 because that's the money that I put in. However, in 2028, I will start cash flow or cash flow negative in my case. So I'm doing $500 negative cash flow every single month, and therefore I would be almost $6,000 cash flow negative for year number 1 after possession. Obviously, my rents will increase. I've taken a 5% increase in rents every single year, and overall, still I'll be losing by the end of 2032. I'll be losing almost $15,000 in cash flow. Even though I'll probably cash flow or break even in 2032, but overall I have lost about $15,000 in approximately 5 years, in cash flow, because I'm negative on it. So the total invested money is basically invested plus the cash flow negative that I have. So overall, $149,200 plus $15,000 is approximately $163,970. That's the amount of money that I would have invested in this particular condo. Now let's assume that we are able to sell this condo for almost $900,000 in 2032. So now that we know how much money we invested overall, including the cash flow negative and the money invested upfront in deposits, closing costs, and down payment, we now also look at our mortgage balance, because the mortgage balance gets paid off every single month. Yes, we are cash flow negative, but that cash flow negative is also going towards our principal. So like essentially we are covering our expenses. The only thing that we are putting from our pocket is the principal that goes towards our mortgage pay down. So the mortgage balance after the pay downs every single month across 5 years, our balance would come down to about $467,000. And if we are able to sell this house for about $900,000, let's assume 5% fees in realtor, lawyer, everything, penalties, whatever, we will, the net of sales before tax will be about $854,000, and the net proceeds will be about 854 minus 467, which is about $387,000. This is before tax. Now, obviously, we invested $163,000, and this $163,000 has more than doubled in approximately 5 to 6 years. Now, of course, I've taken a lot of assumptions. For one, I've assumed that the property price increases by about 5%. If it doesn't increase by 5%, my returns will not be as much. But the important thing to understand is when you have money, you have a choice. Whether you want to invest in real estate, or you want to invest in stock market, or you want to invest into your business. Now, I cannot do a comparison with business, but I can do a comparison of this particular, increase from 163 to $387,000. So if you were to not put into this pre-construction, but if I were to put all these deposits into the stock market and it grows by about 10% year on year, where will I be? So the next slide, again, it's very complicated, and just, bear with me. I'll explain it one by one. Let's assume that instead of putting the deposit, which is 32,300, which I put in station side, instead of putting it in station side, I actually put it in the stock market, and the stock market grows by, let's say, 10% year on year. I am actually being very, very generous here. It could be more, if you're investing in India, but let's assume it's 10% year on year for every year. So if I increase a 10% year on year, it'll by 2032, when, I'm selling that particular condo, this 32,300 will be close to 69,238. It's just mathematical. I've just taken a 10% year on year increase, and yeah, we are at about $69,000. Now in year 2, which is 2025, I'm making another deposit of 32,300 towards my condo, and that deposit, again, I invest into the stock market, and again by 10%, with a 10% year on year increase, I'm at $62,000 or $63,000. Again in year 3, which is 2026, I again have to make a deposit towards my station side, and instead of doing that, if I again invested into the stock market, I'll be at 57,000. And again, the last one, which is my last 32,300 plus the $20,000 of closing cost, which is 52,300, I again invest into the stock market, and it grows by another 10% every single year. And by the end of 2032, my overall, returns, including the appreciation and the principal that I put in, will be about $273,633. So if I put the same deposits and the same money, instead of doing it in a pre-construction, if I put it in the stock market, my money will grow to about $273,000. Now, this $273,000 is a lot lower than, almost $115,000 lower than what we would get in my previous example, where I assumed that the station side condo, the prices increase, the value of those condos increase 5% every single year. Now, you might say that 5% is a higher number, but then again, I took a higher number here as well in the stock market. So the comparison is like to like, and therefore I feel that station side is a better investment, just purely based on numbers. Now, I'm not saying that everyone should do station side, because real estate comes with added risks. One is the appreciation risk, right? Whether it will appreciate or not. But there is also a risk that the tenants might not pay, so that's added risk. Then there is also risk of vacancy. If the tenants leave, it might not, it might be vacant for a couple of months, and you might have to carry the payments. So all those risks are also there. There's risk of maintenance as well. Something might break. You might have plumbing issues. All those risks actually come. But sometimes the increased returns that you get in real estate do justify all that pain that you go through, to manage and maintain the real estate that you buy. Now that we understand how to do pricing analysis, and I've taken just this example, you can actually apply this pricing analysis to anything, but we have to look at different factors when buying this real estate. I do not like to lose money, and that's why you see me do all this analysis, and I would highly recommend that you do that for yourself, irrespective of what you're buying. Now, why Precon for me? I could have bought a resale house as well. I have a few reasons for that. Number one is that because I'm self-employed, I have low mortgage eligibility right now. I already own a few units, and my bank eligibility is maxed out. My income has been up and down a lot in the last 3 years being self-employed, and therefore I will not be eligible for a bank mortgage. And right now the B lender rates are almost 7%, and that's where I don't think that I'll be able to cash flow, or I'll be cash flow negative heavily if I do a 20% down. So that was my number one reason for not buying a resale house right now, because my cash flow will be severely negative if I do that. The second reason is my primary home is up for renewal in 2025. I am already at a B lender because when I bought my primary home, or I closed my primary home, I was only 1 year into business, and therefore no bank would touch my file, and therefore I had to go to Equitable Bank, and my interest rate is almost 6.3%. Now my home is up for renewal. I took a 2-year mortgage in 2025, and I am likely to move to a bank now because my home value is a lot higher. I have prepaid a little bit of my mortgage, and my overall home only has about 60% loan left on it. So 40% is already paid, and it's part of equity. And therefore, I really feel that I don't want to jeopardize my chances of going to a bank at a much lower interest rate and lowering my payments next year. And that's one of the other reasons why I did not want to buy real estate that I have to close and get a mortgage on my name. The third reason is I might upgrade my primary home next year. So when my loan is up for renewal, there's a chance, depending on how the market goes, I might upgrade into a bigger house. And that's another consideration that I had to make, because if I buy something right now, my eligibility will reduce further, and I'll have to stick to a B lender, which is something that I'm trying to avoid for 2025. I don't own anything in GTA. That was my fourth reason. It's a very stupid reason, I would say, but still, all my investments are in Kitchener. So 2 of my houses are in Kitchener. I have my Calgary investment, then I have my US investment, but I don't own anything in GTA, and that is something that I always wanted to do. And I feel that now I have 2 condos which are close to the GO station. One is this one in Milton, and my Kitchener condo is also right opposite the Kitchener GO. It's a really good investment. You can't go wrong there. I don't want more tenants right now because I'm growing my business. I don't have the time to deal with tenants. I don't have the time to deal with vacancy. I don't have the time to deal with property management, and therefore I really feel that I don't want tenants right now. 2027, 2028, I'll be a lot more stable in my business, and that's where I'm okay having tenants at that time. Plus, it's not the best time to have tenants anyways, purely because the job market is so low. So there's a high chance that there are high defaults happening in the next 1 to 2 years. I don't want to get into that headache, knowing that I'll be investing a lot of my time right now into my business. And it's a good defense to my offense. But what I mean by that is that this is not the only investment that I'll make. I talked about that in my goals video. I talked about that in my real estate video as well, in a couple of videos that I made this year, that this is not my only investment. This was just one defensive approach where I know that I'll not lose money in 2027. And I just want to park some of my funds there, and just it's a good way to save forcefully, because I have to make the deposits towards this pre-construction, but I also want to do an infill project, a land development project, a flip, something which is a little more riskier and a little more of like on the offense, and this will act like a good defense to that offense. Plus, I'm going very hard on my business as well. All the studio that you see, I invested a lot back into my business. So pre-construction is always a very good defense to all the offense that I'm doing this year, to ensure that if everything goes wrong, I still have a piece of real estate that I'm saving towards separately. That's it for me for this presentation. If you are interested in booking this unit that I booked, there's a link in the description. You can just go to that link and book a call, and one of my team members, my realtor partners, would take you through the plans and book a unit for you as well. Even if you're not interested in booking this unit, and if you're interested in other projects that I'm doing, I would recommend that you also go in the description and click on the investor list and be part of our investor list, so that whenever there is an amazing investment opportunity that I am personally invested in, I can actually share that with you as well. I can't promise you that there'll be a every week I'll be sending you an email. That's not what this is for. But if I have a really good investment opportunity, I would want to share it with you. So do be a part of that investor list as well. And the third thing is that if you want to be on my newsletter list for every week, there I don't talk about real estate most of the times. I don't upsell anything. I just talk about my experience of building my business, and I give really good insights on how you can do what I am doing. So if you're interested in doing that, you can also subscribe to the newsletter. A lot of things to get subscribed, but just to summarize, if you want to book this unit, book a call in the Calendly. If you want to be part of the investor list so that you don't miss out on any deals, just be a part of the investor list. And if you want to be a part of my weekly newsletter that I send, it's all value, no upselling, no selling. देन जस्ट सब्सक्राइब टू द न्यूज़लेटर. ऑल 3 लिंक्स आर इन द डिस्क्रिप्शन बिलो. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय. रोल इट. एक्शन. चल रहा सब कुछ.